Hi, this is Jim Juback for Juback Asset Management Daily Video on YouTube, and it is Wednesday, April 9th. Here in Venice, like everyone else, everywhere, probably everywhere in the world which has a news feed, we're trying to get some light in the chaos. Here in Venice, the light is, over the weekend, the wisteria started to bloom. So you can see these wonderful purple flowers coming over the walls from the interior gardens into the Calle. We don't have Via or Strada in Venice. It's Venice, not Italy. So they're called Calle. Anyway, so wisteria in bloom, promise of spring, promise of light and warm temperatures and sun and all those good things. Anyway, I'm going to be posting some wisteria pictures in the next day or so on our Substack called We Moved to Italy. So if you want some beautiful purple flowers, it's free. Go to Substack, We Moved to Italy. You'll find a link to that down below. In fact, you'll find lots of links down below. Links down below. There is a link to signing up for this YouTube channel. If you sign up, that gives you notification of when we do our next one. We're trying to do about 3 a week. Maybe I'll get back on regular schedule, but when there's a good day and a possibility of sitting out in the Zattere and watching the boats go by on the Laguna, it's hard to stay at the computer, frankly. But anyway, if you subscribe, you get a notification when we do the next one. We're trying 3 a week. If you want more of my free stuff, you can go to jubackpicks.com. That's got 3 portfolios for 12 to 18 months, 5 years longer, and dividend stocks, and that's free. Sign up. Just give us your email and we'll send you alerts every day so you get them when the market, after the market close. Or if you want 6 portfolios instead of 3, so we add an ETF portfolio, which is kind of interesting these days. I just moved from a dollar ETF to a yen ETF just before that became a good move because of the Trump tariffs. I've also got a volatility portfolio where we've been doing some options plays to try to hedge some of this risk. And finally, a really long-term portfolio, which is deeply, deeply into the red, which is where you want to be if you're building a portfolio. Anyway, so those 3 on Juback Asset Management. And of course, the Substack. You find links to all that stuff down below. Okay, today's topic, no Powell Put Yet. Now, a Powell put would be a bet that the Fed is going to come in and rescue the stock market at some point by flooding the market with liquidity, and that'll drive stock prices up. And if you believe that's going to happen, you should probably be buying stocks right now. My take on this is that it's early for that. Remember, the Fed has 2 principal directives set up in the Humphrey Hawkins Fed Reform Acts of 77, 78. Basically, they are to ensure maximum employment. That's not full employment. It's not zero unemployment. It's maximum employment that's commensurate with the other goal, which is stable prices. You'll notice there's nothing in there that says, hey, when the stock market goes down, and we'll raise $9.5 trillion in U.S. stock market valuation in the last few days. There's nothing in there that says, hey, when the stock market goes down, the Fed needs to rescue it. I think short of some systemic problem starting to crop up, and there are a few that I'm going to be writing about in the next couple of days that are possible places for that to be happening, including another video this week on where that might be showing up. Short of that, I don't think the Fed is going to move until it sees more weakness in the economy. The last jobs number for March was strong, but we haven't yet seen the full effect of the DOGE cuts on the federal workforce or the shift in expectations and business spending and consumer spending because of the tariffs. We haven't seen that in the data yet. Until we see that, the Fed's going to be reluctant to put more money into the economy because, hey, if this economy is strong, you don't need to. And especially if you're looking at tariffs and going, gee, those are really inflationary over the long term. So I really don't want to be adding more stimulus to the economy yet. So I think the market is getting very, very ahead of itself in terms of betting on a Fed put. That on Monday, the 7th, the consensus in the futures market was moving toward 3 interest rate cuts by the Fed. In fact, there was some chatter from usually informed, but now I think really fearful people on Wall Street about maybe an emergency Fed cut before the May 7th meeting, which is the next time the Fed meets. And so basically what Wall Street is saying, hey, we might get an emergency Fed cut because after all, we're in pain. Well, yes, but I think an emergency Fed cut would just send a message to the larger market that there's really a lot to be afraid of. So it might be counterproductive. I don't think the Fed will do that. Again, absent some kind of systemic problem in the financial system. And I don't think the Fed is going to move as early as May. June is possible, but not really likely. I think the Fed is being very data cautious, and it's just not going to get enough data by that point to make it reasonable for them to cut interest rates. The consensus of if you look at it, there are people saying we're going to get a cut in May or June, and then a cut at every meeting. There are people out there talking about 5 cuts in 2025. I just don't see it in the Fed's composition and the Fed's caution. And I don't see it before. Everybody's really been missing Plan B, which is that Trump doesn't have to come out and say, hey, the tariffs were a big mistake, let's revoke them. He can say, hey, we're about to give you a huge tax cut, and that will just make all these problems go away. So until the Republicans in Congress actually deliver the tax cut, and they will, one way or another, Lindsey Graham has made it clear that he doesn't care what the rules are in the Senate. He's going to jam it through. So it will happen. Until it does, the Fed will be sitting there going, well, gee, it's a potentially big stimulus to the economy in 2026. Do we really want to be stimulating the economy in 2025, knowing this is coming down the pike? So all these things say, I don't think we've got a Fed put in place yet. Right now, let's see, we closed at Friday the 4th at the S&P at 5074. The Fibonacci retrace, if you want to get into technical the idea is in Fibonacci numbers is that you look at how big the move has been up, and then when you get a downturn, you retrace part of that. So a 50% retrace, which would be pretty normal, would take us down to 48.19 from, it's another 250 points down from here. Not a huge move. That's what, 5%. The 200-day average is at 46.74. So that's another support level. So those are the 2 next things to look at if you're thinking about a Fed put, you're thinking about where the market might go. If we get to those levels and test them, I think we'll get a short-term rally. If we get to those levels and go through them, the next stop, because Wall Street likes round numbers, is 4,500. So that's still, 10% down from where we are today. But that's what we're really looking at. And if you're betting on a Fed put and betting on massive interest rates, I think you're ahead of the game. I don't think we're there yet. And this is how I would be looking at the market and thinking about when I want to put money in. One of the real traps in a bear market, which is where we are now, we've got 20% down. One of the traps in a bear market is you get these rallies, which then suck more money in at the bottom, and then turns out that's not the bottom. And you end up sucking more money in, and then you put in a new bottom and do maximum damage to people. That's what we did in the housing crisis, 2008. The rally was people bet on the rally before it actually arrived, bet on the bottom before it arrived, got more money in. So I would be very careful trying to find a bottom here until we play out all this stuff with interest rates and the possibility of a Fed put, which I don't think is very possible, tax cuts, et cetera, et cetera. So be careful here. Don't get sucked in on an early bottom, because that's exactly what the bear market likes to do before it grabs you. Thanks very much for watching. If you like this video, please give it a thumbs up. Go to YouTube, subscribe to my YouTube channel. It's for free. That way you get notification of when we do our next one. We're trying to do about 3 a week. If you sign up for free, you get notification, an email telling you when the next one's coming up. If you like more of my free stuff, you can go to my jupacpicks.com. 2 posts a day, 3 portfolios for 12 to 18 months. 5 years and dividends, or you can subscribe to my paid site. That's Jubac Asset Management, jubacam.com. And that has 6 portfolios, those 3 plus a volatility portfolio, very useful right now. An ETF portfolio, also I think useful right now. We've made 1 or 2 moves in it recently to accommodate a new reality, and then a really long-term portfolio. So if you're looking for getting in a bottom and you got 30 years to go, that's a portfolio that should be of interest to you. Also, last thing is that I moved to Italy in September of 2023. Long-term goal of my wife is to live in Italy, and so we're doing it. We're in Venice right now. With at some point we will return. Don't know when. Depends on all kinds of things, mostly health and missing our kids and stuff like that. So anyway, if you want to follow our adventures in Italy, we started a Substack called We Moved to Italy. And that's also free. And you can find links to all this stuff down below. And don't forget the wisteria pictures on the Substack. Thanks very much for watching.